Wall Street just had a wake-up call, and it cost investors billions. Software stocks have crashed 15% since January, marking the worst start to a year since 2022. The trigger? Anthropic launched a legal AI tool, and within hours, major data services companies saw their stock prices plunge by double digits. Wolters Kluwer dropped 7%. RELX fell nearly 8%. Intuit crashed 16% in a single week. This isn't speculation about AI disruption anymore. This is institutional money fleeing software categories that AI is actively demolishing. And while Wall Street panics, a startup called Railway just raised $100 million to build what they claim is the cloud infrastructure that AI actually needs. Two different responses to the same seismic shift. Let's break down what's happening. Let me set the scene. On January 12th, Anthropic, the AI company behind Claude, announced a new plugin specifically designed for in-house legal teams. This tool automates contract review, NDA triage, compliance workflows, legal briefings, and templated responses, all configurable to an organization's specific playbook and risk tolerances. The plugin works with Anthropic's agentic desktop application called Claude Cowork and also integrates with their coding assistant Claude Code. The market's reaction was immediate and brutal. Shares of Wolters Kluwer, the Dutch legal and regulatory information giant, dropped more than 7% in mid-morning European trading. RELX, the UK-based data analytics company, fell 7.8%. Even Pearson, primarily known for education, sank 3.2%. But this wasn't just about legal software. The announcement triggered a broader exodus from the entire software sector. Jordan Klein, a tech sector specialist at Mizuho Securities, wrote in a note to clients that, quote, many buy-siders see no reasons to own software no matter how cheap or beaten down the stocks get. TurboTax owner Intuit tumbled 16% in a single week, its worst performance since 2022. Adobe and Salesforce both sank more than 11%. Meanwhile, Figma, the design software company that went public in July 2025 at $33 a share, has completely collapsed. The stock initially exploded on AI hype, soaring from its IPO price to a high of nearly $143 by August. Then reality hit. By late January, shares had crashed to below $27, below the original IPO price. The company that Adobe once offered to buy for $20 billion now has a market cap of around $12 billion, with big net losses expected for years. Figma has officially joined what analysts call the imploded stocks list, requiring a 70% crash from recent highs to qualify. Here's what makes this different from previous AI hype cycles. This isn't investors betting on which AI company will win. This is investors actively fleeing companies they believe AI will destroy. The distinction matters enormously. Brian Wong, a portfolio manager at Osterwise Capital Management, put it bluntly, quote, the latest news from Anthropic highlights just how hard it is to model future growth for traditional software companies, end quote. When institutional money can't model your future, they sell. Private equity is feeling this too. Apollo Global Management's John Zito reportedly left an audience of investors stunned at a gathering in Toronto when he said the real threat for private capital markets wasn't tariffs, inflation, or elevated interest rates. His actual words, quote, the real risk is software dead. But here's the twist. Thoma Bravo's Orlando Bravo sees the same disruption and calls it, quote, incredible buying opportunities. Vista Equity Partners, managing $100 billion in assets across 90-plus software companies, has created something they call an agentic factory, a system to deploy AI across their entire portfolio. 30 of their companies are already generating revenue from agentic AI conversions. This is the market splitting into two camps: those who believe AI destroys software, and those who believe AI transforms software. Your position determines whether you're selling at the bottom or buying the dip. Watch for M&A activity. Multiple analysts expect the software sell-off to trigger a wave of acquisitions, with private equity swooping in on depressed valuations. Figma has earnings coming up on February 18th. That report will signal whether the market's fears about AI cannibalization are justified or overblown. And pay attention to Anthropic's next moves. If legal AI triggered this sell-off, imagine what happens when they announce tools targeting other software categories. The disruption is just beginning. So while Wall Street debates whether traditional software is dying, there's a completely different story unfolding in infrastructure. Because if AI is reshaping what software gets built, it's also reshaping where and how that software runs. And one company thinks the entire cloud computing model needs to be rebuilt from scratch for the AI era. They just got $100 million to prove it. Railway is a cloud platform that wants to make infrastructure invisible. Founded in 2020 by Jake Cooper, a former engineer at Uber and Bloomberg, who rebuilt the Wolfram Cloud, the company just announced a $100 million Series B round. The round was led by TQ Ventures, with participation from FPV Ventures, Redpoint and Unusual Ventures. This brings Railway's total funding to over $130 million. But here's the number that matters most. Railway has 2 million developers on its platform. And according to Cooper, they achieved this growth with minimal marketing budget, relying almost entirely on word of mouth. The platform now handles roughly 100 billion requests monthly across 6 million microservices and 20 million deploys. By late 2025, Railway powered 25,000 businesses alongside individual users. So what does Railway actually do? Cooper describes it as making deployment orders of magnitude simpler than AWS. Quote, "You type in I want Postgres and we return to you an active Postgres," end quote. Tasks that require deep infrastructure knowledge and DevOps engineers on AWS become trivial on Railway. The company is explicitly positioning itself as AI native infrastructure. Cooper stated, quote, "As AI models get better at writing code, more and more people are asking the age-old question, where and how do I run my applications? The last generation of cloud primitives were slow and outdated, and now with AI moving everything faster, teams simply can't keep up," end quote. With the new funding, Railway plans to pursue GPU integrations, agent orchestration, and global expansion. The company's annual recurring revenue exceeds $10 million, modest compared to AWS, but growing rapidly in a market where the incumbent suddenly looks vulnerable. This is a David versus Goliath story, but David just got a serious slingshot upgrade. AWS dominates cloud computing. They essentially invented it. Challenging them directly sounds absurd, until you realize that AWS was built for a different era. The traditional cloud model assumes you're deploying relatively static applications with predictable compute needs. You spin up EC2 instances, configure load balancers, manage containers. It works, but it requires DevOps expertise and constant maintenance. AI workloads are fundamentally different. They're bursty, GPU-intensive, and often unpredictable. They need infrastructure that can scale instantly and handle novel deployment patterns. Railway's bet is that AI-native infrastructure will become essential, not optional. As AI coding assistants like Cursor, Copilot, and Claude Code enable more people to build software, the deployment bottleneck becomes critical. If anyone can write code, but only experts can deploy it, you've just moved the barrier, not removed it. The 2 million developer number without marketing spend is the real signal here. It means Railway solved a genuine pain point that developers cared enough to tell other developers about. That's not hype, that's product market fit. And product market fit in infrastructure is rare and valuable. The GPU integration roadmap is crucial. If Railway can offer seamless GPU compute for AI workloads, something that's notoriously painful on traditional cloud providers, they could capture significant market share as AI development explodes. Watch for enterprise adoption metrics. 25,000 businesses is impressive, but Railway needs Fortune 500 logos to be taken seriously as an AWS alternative. And keep an eye on the agent orchestration features. As AI agents become more autonomous, infrastructure that can handle their unique deployment patterns becomes a competitive moat. The software industry is being squeezed from both ends. AI is eating the applications, An AI-native infrastructure is coming for the deployment layer. The companies that survive will be the ones that adapt fastest, or get acquired by those who do. The question isn't whether disruption is coming. It's whether you're positioned to benefit from it, or become another cautionary tale. If this breakdown was useful, subscribe. We cover AI and tech news daily. See you in the next one.